In the alternate version of Quick Study 9-10, we address contingent liabilities. And as your Learn Smart module indicated, contingent liabilities are potential obligations that depend upon a future event arising from a past transaction. And lawsuits are a good example of a contingent liability. And we're going to look at some various legal claims that exist for Mfinger Company as the defendant in these lawsuits. And why a lawsuit is a good example of contingent liability is that if, as of the financial statement date, so when we're preparing the financial statements, if the lawsuit hasn't been settled, that's the future event, the actual settlement of the lawsuit. If that hasn't been done, we don't know exactly that we're going to lose or what exact amount that we're going to have to pay out. That's a future event. Remember, I also indicated that this arises from a past transaction or event. So something's happened in the past to bring about this lawsuit. Have we maybe created a product that's harmed our customers and so they're suing us? Or maybe not necessarily created the best working environment for employees, so we have a disgruntled employee that sued us. That's the past transaction or event that's brought about this lawsuit. Now, how or if we record this contingent liability depends upon what criteria it falls within. Unfortunately, all contingent liabilities aren't treated the same. Wouldn't it be easy if it was? But it depends upon what criteria it falls within. The bottom lowest level is this future event remote or unlikely? A little bit higher is it reasonably possible? It could occur that we could have a loss. And the highest level is it probable or likely that we'll have a loss? It also depends beyond these three criteria is, can we reasonably estimate the dollar amount? So we have to look at, is it remote? Is it reasonably possible? Is it probable? And can we estimate the dollar amount to determine how or if we record it at all? So it's possible that we may record a liability, meaning we would make a journal entry. It's also possible that instead we would simply just describe it in the notes to the financial statements as full disclosure. So no journal entry, but at least make a notation at the end of our financial statements. And I don't have it listed here, but another criteria would be I don't do either. We don't make a journal entry and we don't list in the financial statements. So let's start to work through our different independent situations and decide how or if we record them. Mfinger, the defendant, estimates that a pending lawsuit could result in damages of $50,000. It's probable that Mfinger will lose the case. So what do you think? A liability is going to be recorded. The reason why is we can both estimate it's $50,000 and also the loss is probable. If it's both, we're going to make a journal entry for it. We're going to record the liability. What about our next situation? A disgruntled employee is suing Mfinger. Legal advisors believe the company will probably need to pay damages. So we stopped there and said, well, this looks a lot like number one where it was probable. Will we go ahead and say, yep, we're going to go ahead and record a liability. We're going to make a journal entry? No. We add a little caveat. We can't estimate the amount. We can't reasonably estimate the amount. Because of the fact, even though it's probable, since we can't reasonably estimate, we're not going to record a liability, but we are going to describe it in the notes to the financial statement. If you think about it, if I really can't estimate a dollar amount, how would I make a journal entry? Because you got to debit and credit for some type of dollar amount, so how could I make a journal entry? What about situation 3? Mfinger faces a loss on a pending lawsuit that is unlikely to lose. The loss is reasonably estimated to be $100,000. Remember I talked about can we estimate or not? We can estimate $100,000. Well, in the first situation, we could estimate that it was $50,000. So it seems like because when we could estimate in the first situation that we recorded a liability, wouldn't we do the same here? No. It's because it's unlikely. We're unlikely to lose. In this situation, we wouldn't do either. We wouldn't describe it in the notes to the financial statements, and we also would not record a liability because while we can put a dollar amount behind it, we know what they're looking for. We've identified it's unlikely or remote that we're going to lose. In that situation, we would do neither. Now, if I change this around a little bit, instead of unlikely or remote, said it's reasonably possible, would that change this? Yes, if the third situation changed from unlikely to reasonably possible, then we would describe it in the notes to the financial statement. One last question. If I take all three situations, they have three pending lawsuits together, what's the total amount that M. Finger Company would record in its accounting records related to these suits? Now, I want to point out something. Recording in its accounting records means which ones are we recording an actual liability? Which ones are we doing a journal entry for? We're not asking to include also those items that are addressed in notes, but which one are we recording a liability? Which ones are we making journal entries for? So what's the total amount that we're going to record for all three situations altogether? And it's going to be $50,000. Again, you might have looked at this and said, well, $150,000 because I can see another dollar amount. But recall, because we identified we're unlikely to lose this, we did not make a journal entry for it. So the total amount recorded in the accounting records as far as dollar-wise is going to be $50,000.